coronavirus outbreak in China has emerged as the biggest global worry at the moment. Now, this outbreak, if not contained well in time, may actually turn into a global epidemic with the obvious adverse implications for global travel, trade, and also markets. Let's do a three-point analysis to really understand the gravity of the situation and also the implications for the global financial markets. 1. What is corona outbreak? Well, on 31st December 2019, WHO alerted on several cases of pneumonia in Wuhan city of China. Now, virus was termed as coronavirus, which belongs to the family of viruses that cause illnesses ranging from common cold to SARS, that is severe acute respiratory syndrome, and also MERS, which is Middle East Respiratory Syndrome. Now, virus strain is novel as it has not been previously identified in humans and has so far now does not respond to any medical treatment as well. Now, coronavirus is also understood to have been initially transmitted from animals, possibly snakes and bats. Now, it is contagious, and what makes the transmission difficult to contain at initial stage is in fact that is the incubation period, that is the time from exposure to developing symptoms is about 10 to 14 days. 2. What are the repercussions then? Well, as the outbreak occurred on a run-up to the Chinese Lunar Year celebrations, the usual trend of consumption and tourism boost during this time is adversely impacted. Now, markets have also started to price in the crisis as in an alarming way. The Chinese equities have actually fallen 5 to 6% from January 2020 highs. Oil has also slumped by more than 10% in the last few days, and gold is at a 6-year high. If we compare the similar-looking crisis of SARS in 2003, global macroeconomic impact was estimated to be in a wide range of $30 to $100 billion. It was estimated that the impact on China's GDP was as high as 1%. 3. What are the key takeaways then? Well, in our base case, we believe coronavirus epidemic may have been an impact limited to China, wherein we may see through an extended period of travel ban within China. Now, in the short term, adverse impact on Chinese GDP could be larger than earlier occasions due to the clampdown. As far as markets are concerned, investors should look up to this event with caution, as the solution to epidemic is still binary. Antidote is not available, and the state of the economy has to be reassessed should it at all get available at future date. Now, investors may turn cautious on the sectors or even companies having direct exposure to China, particularly on the commodities side. Now, chemicals or agri-chemicals industries may have to brace up for the oil price volatility in the coming days, as well as a potential high-cost inventories. Now, sectors like pharma, which are dependent on raw materials from China, may also face additional headwinds. Large export-oriented sectors of China, such as metals, chemicals, may possibly resort to higher dumping in countries like India. Now, trends such as these may warrant a close watch for Indian investors as well.